Welcome back to my channel, where we unpack complex finance concepts in just 15 minutes. Today, we are diving into quantitative methods from the CFA Level 1 curriculum. Imagine starting your journey at an automobile workshop. The first step, mastering your toolbox. In finance, it is no different. Quantitative methods are your financial toolbox, the foundation for every decision you will make. Whether it is analyzing data or forecasting trends, these skills are essential. That's why the CFA curriculum prioritizes quantitative methods. It is your toolkit for success in the financial world. In this video, we are decoding the first LOS on quantitative methods, that is interest rate and time value of money. We will cover it all in under 15 minutes. There are two learning outcomes in this video. Number one, three different interpretations of interest rate. Number two, determinants of interest rate. Interest rates can be interpreted in various ways, each influencing financial decisions differently. Let us explore three key interpretations with an example. Number one, the required rate of return. Number two, discount rate. Number three, opportunity cost. Let us see the examples now. Imagine you have 100 rupees today. There is a present value and you require a return of 5%. After 1 year, you will have 105 rupees. That will be the future value. You can see the calculation as well. You have 100 rupees here and at the rate of 5% interest rate, you can earn 5 rupees. So total turned out to be 105 rupees. I have written in a different format. 100 I have taken as a common. So it will be 1 plus 5%. So 100 multiplied by 1.05. Here, the interest rate is interpreted as required rate of return. Let us see another example. Here, you expect rupees 105 in 1 year. That will be the future value. And you want to find its present value. So, you use a discount rate of 5% to calculate the present value of it is 100. How you will do that with the calculation? 105 divided by 1.05. Here it is interpreted as discount rate. We will check another example. You have 100 rupees today. If it is consumed today, you are losing an opportunity to earn rupees 5 after 1 year. So this rupees 5 or this 5% is the opportunity cost of current consumption. Now let's see the determinants of interest rate. Interest rates are influenced by several factors. Based on economic theory, it can be determined by the interaction of supply and demand in the financial market. Investors supply funds, borrowers demand funds. Increased investor savings, that is supply, leads to lower interest rate. High borrowing demand leads to higher interest rate. Or it can be market determined. This market determined interest rate composed of real risk-free interest rate plus set of premiums to compensate various risk. What is the real risk-free interest rate? It is the compensation for postponing a consumption without any inflation or default risk. It represents the pure time value of money and it is a theoretical concept used to gauge the baseline return on investments. Let's see the explanation for real risk-free interest rate through an example. If you lend rupees 100 to a highly trustworthy borrower and we assume there is no inflation and we are receiving rupees 102 after 1 year, the rupees 2 earned here is the real risk-free interest. Real indicates no inflation, risk-free indicates no risk of default. Now let us see the other determinants of interest rate. Inflation premium. It compensates investors for the expected inflation. Next one, the default risk premium. It compensates the investor for the possibility that investor can fail to make payments on contracted time and contracted amount. When we apply for a bank loan, if we lack a stable income source, banks may offer us loans with high interest rate. Conversely, having a steady income allows us to secure loans at lower interest rate. Banks seek greater compensation from borrowers they perceive as less reliable. The next one is liquidity premium. It compensates investors for the risk of loss related to an investment's fair value. To understand liquidity premium better, we need to know first the what is liquidity. The liquidity of a financial asset refers to how quickly and easily it can be converted into cash without significantly affecting its price. Highly liquid asset means we can sell that asset at its fair price quickly. Investors are compensated for the risk of investing in assets that lacks liquidity through liquidity premium. In India, stocks are generally liquid as they are trading frequently in stock exchanges, whereas bonds, being less frequently traded in over the counter, that is OTC market, require investors to demand. When we combine real risk-free interest rate and inflation premium, we get nominal risk-free interest rate. We can calculate this nominal risk-free interest rate by simply adding real risk-free interest rate and inflation premium. But this is an approximation only. The right way to calculate is 1 plus real risk-free interest rate multiplied by 1 plus inflation. Why we should use this method to calculate nominal risk-free interest rate? Let us see through an example. Let us assume the real risk-free interest rate is 2% and inflation is 3%. Then the nominal risk-free interest rate is 2% plus 3% equal to 5%. Again, as I already told, this is an approximation only. The right way to calculate is 1 plus real risk-free interest rate multiplied by 1 plus inflation. So how it will be? 1 plus 0.02, that is the real risk-free interest rate multiplied by 1.03. It gives us 1.0506. Here the nominal risk-free interest rate is 5.06, not 5%. Why should we follow this method? Let us check it out. Let's say we have rupees 100 now. The real risk-free rate is 2%. So it will be 102 after 1 year. Now we will apply 3% inflation on this 102. So how it will be? 102 is the total amount we got after applying real risk-free rate. Then we apply inflation on 102. So we get 3.06. So if we apply inflation on 100, then we will get 3 only. So our total amount will be 105. But we should apply inflation on 102, not on this 100 rupees. That is the difference. So when we apply inflation on 102, we will get the total amount will be 105.06. So the nominal risk-free interest rate is 5.06%. Typically, the interest rate of short-term government debt serves as a proxy for the nominal risk-free interest rate. This is because government securities are considered risk-free and already factored in the expected inflation. For instance, 90-day treasury bill in the US is used to denote the nominal risk-free rate applicable in US. Interest rates are conventionally expressed and on annual basis. For example, if the interest rate of a 90-day treasury bill is stated as 3%, this figure represents annual rate, not the rate applicable solely for the 90-day period.
If you enjoyed this video, please hit the like button and subscribe to AZ Alpha to access all CFA content.